Hi friends, I welcome you to a lecture on accounting for customer loyalty programs. So we are going to discuss Appendix B2 Indas 18, which corresponds to Ifric 15. So we are going to learn how to do accounting for customer loyalty programs. See, before we go into the appendix, before we go into the standard, I hope you all would have encountered this in your regular day-to-day life already. So when I use my credit card, the credit card company is giving me certain points, and in future I know that I can use these points to buy some gifts or to buy some goods, maybe buy a pen or maybe buy movie tickets with it. So for using my credit card regularly, and whenever I make purchases using my credit card, whenever I use my credit card for making payments, the credit card company is giving me certain points. These points are called as awards, and in future, or we can call them as award credits. So I'm getting some points which is technically called as award credits, and in future I can redeem these points for buying gifts, for buying pens or buying a movie ticket, etc. And these movie tickets, these pens are awards for me, or we can say these are rewards for me which are given by the credit card company for using the credit card continuously. Or you would also have encountered, suppose you buy a ticket, air ticket from an airline company, they are giving you some points. In future you can accumulate these points and you can use these points to buy a ticket for free from the same airline, or you can use these points for getting a discount on your next ticket. So how do the program operators, the credit card company which is giving you the points, the airline which is giving you the points, how do they account for these points in their books of accounts is what we are going to discuss. So when they grant these points, how to account for them. When the points are redeemed by the customer to get some goods for free or at a discount, how to account for this in their books of account is what we are going to discuss in this standard. Appendix, that is Appendix B, which is attached to Indas 18, and the corresponding international standard is Ifric 15. So we are going to discuss this in our presentation. Let us go to the background. So customer loyalty programs, we call them as customer loyalty programs, are, we can say, programs which are implemented to provide incentives to customers so that the customer will continue to buy our goods and services, he will continue to be loyal to me. And these programs, when the customer buys goods or uses our services or uses our resources, we are going to grant him some points. In future he can use these points for the purpose of getting some goods or services for free from us or at a discount from us. So this is the general background. Let's go ahead with it. Customers sometimes are required to accumulate a minimum number of points before they can redeem these points for free goods or services. Sometimes the rewards in exchange for these points are provided by the entity which is granting the points. Sometimes the rewards, the gifts, are being provided by a third entity. Okay, so it can operate in both the ways. And sometimes the points are coming from individual purchase, or sometimes they are coming from group purchases. So we can just discuss the overall background. When a customer buys goods from us, when he uses our services or when he uses our resources, we are granting him some points. In future he can use these points to get some goods or services for free from us or at a discount from us. Or sometimes we will grant the points but customer can get the goods, get the rewards from a third party. So how to do the accounting for these points when they are granted, when they are redeemed, is what we are going to discuss in this particular standard. So now applicability. So this particular appendix is applicable only in a situation where a sale takes place, you sell goods, you provide services to your customer, and when you sell the goods and you provide the services, you get some consideration from the customer, you grant the customer with some points. We call them as award credits. And in future the customer can use these points to get some goods for free or at a discount. So in this circumstances only, how to account for this loyalty program in the books of the loyalty program operator is what we are going to discuss in this appendix. Okay, if suppose the customer is getting some free vouchers without buying goods, without taking our services, he is getting free vouchers and he can use these vouchers to get our goods or services at a discount. How to account for them is not going to be covered by the standard. So when he buys goods and services and we are granting him some points, using these points he can get some goods at a discount for free. How to account for it in the books of the program operator is what we are going to discuss in this appendix. Okay, let us go ahead. Now, what are the issues involved here? See, by now you would have understood that the loyalty program operator when he sells goods to customers, he is granting some points, and in future these points can be used to get some goods for free or at a discount. So now we know that the seller, when he is selling the goods, he has an obligation. The obligation is he is granting some points. In future, in exchange for these points, I have to provide him some goods for free or at a discount. So I have an obligation. So how to account for this obligation in the books of the seller is the question. So there are two options possible here. We can say there are two possible accounting policies, two ways of thinking about this issue. So the first way is what we are saying. The first point of view, or we can say one alternative accounting policy can be, so when the initial sale transaction takes place, under which we give some points to the customer, what we can say is when the sale takes place, the total consideration received or receivable has to be allocated to the various parts of the sale transaction, and one of the part is granting some points to the customer. So what we should do is, when the sale takes place, out of the total consideration, allocate a portion of the consideration to the points granted based on their fair value. Based on the points fair value, a portion of the sale transaction, the sale price, has to be allocated to these points. In future, when the points are redeemed by the customer in exchange for goods and services, the fair value which has been allocated to these points can be recognized as revenue, and related cost will be booked. So let us say the 100 rupee, let us say 10,000 rupees is the value of the sale transaction, and some points have also been granted to the customer. So out of this 10,000 rupees, the total sale consideration, a particular portion of the consideration has to be allocated to the points, and how much will be allocated will depend upon the fair value of the points. That means out of 10,000, a particular portion has to be allocated these points, and in future these points, the fair value which has been allocated to the points will be considered as deferred revenue. That means out of 10,000, a particular portion is considered as deferred revenue. It is carried forward as liability, and in future when the points are redeemed by the customer, this deferred income will become income for the company and will book the related expense for providing the goods and services to the customer. So this is one way of accounting. So when the transaction takes place, sale transaction takes place, allocate a portion of the consideration to these points, carry it forward as deferred revenue, and then recognize it as revenue in the year in which I fulfill the obligation towards those reward points. That is one accounting possible, and which is prescribed by para 13 of Indas 18. And the second way of thinking, or the second accounting policy which is possible, is I sell goods and I have granted some points. I know that in future I have to satisfy these points by providing goods and services to the customer. That means in future I have to incur cost in exchange for these points. So one way of thinking is we have to provide for the cost which have to be incurred to provide goods and services in exchange for these points. Okay, so this is the second way of thinking. Now a discussion took place and the consensus emerged that we are going to go with the first accounting policy. That means when the sale transaction takes place, allocate a portion of the consideration to the points which have been granted based on their fair value. Entire amount will not be recognized as revenue. A particular portion will be allocated to these points. In future, these points will be recognized as revenue whenever they are redeemed. So we are not in favor of estimating the cost to be incurred to provide benefits in exchange for these points now. So we are not going to provide for the cost. We are going to defer recognition of revenue, and whenever the points are redeemed, we are going to recognize that revenue. So we are going to go for option A, not for option B. Okay. So now, if it is decided to allocate portion of the revenue to the award credit, three questions arise. First, how much should be allocated to these points? Out of the total sale consideration, how much should be allocated to these sale points? Second, so you have allocated a portion of the revenue to these points. When can it be recognized as revenue in our books of account? Third, suppose the rewards are provided by a third party. In such case, how do you measure your revenue? You are granting the points, but these points can be exchanged for rewards from a third party. So how do you measure revenue for your organization in such a scheme is what we are going to discuss. Okay. Now, accounting policy consensus. So consensus has been arrived on this issue, and the consensus, or we can say the desired accounting policy, is when the sale transactions takes place, under which we are granting some points to the customer, at that point of time itself, the consideration has to be, a portion of the consideration has to be allocated to the points based on the fair value of the points, and we are not going to book the entire consideration from the initial sale transaction as revenue. A particular portion will be treated as deferred revenue, and in future when the points are redeemed for goods and services, it will be booked as income in our books of account. So the allocation would depend upon the fair value of the points. How to determine fair value? It should be from the point of view of the customer. What can the customer get in exchange for this point? So from his point of view, you have to estimate the fair value. And based on fair value of the points, a portion of the revenue from the initial period transaction has to be deferred. It has to be treated as deferred income and booked as revenue in the future. So this is what is the accounting policy suggested by this Appendix A. Now, if the entity is going to provide the rewards, see, I told you the loyalty program can be operated in two ways. One, I provide the rewards in exchange for the points, or third party provide the reward in exchange for the points. So suppose the entity has decided that it is going to provide the rewards. Reward is what you get in exchange of those points. So in such cases, when the sale transaction takes place, a portion of the sale transaction should be allocated to these points. These points, the fair value of these points will be taken as deferred revenue, and in future when the points are redeemed in exchange for goods and services, it can be booked as income. So this is the accounting treatment we are going to follow. So when points are granted, out of the total sale transaction in which these points were granted, allocate a portion of the sale price to these points, take it as deferred revenue. In future when the points are redeemed to get services for free or at a discount, book this fair value, this deferred revenue as income, and the cost of providing those goods and services will also be debited in that particular year. So this is the accounting treatment we are going to follow if I operate the service, if I operate the reward points. Example, a grocery store operates a reward system. During the year it has granted 100 points to its customer. 1 point is valid at 1 rupee. Points expected to be exercised is only 80. So even though we have granted 100 points, the grocery store is of the opinion that all the customers may not come back to redeem those points, and only 80 points will be redeemed. That means there can be some forfeitures as well. So end of year 1, 40 points are redeemed. So how much revenue should I book is the question that arises. So first of all, what happens is, when the grocery store has allotted those 100 points, we know that the fair value of each point is 100 rupees. The grocery store will treat 100 points into 1 rupee, 100 rupees as deferred revenue, show it as liability. Okay. And in future when these points are being redeemed, a portion of this deferred revenue will be booked as income. So let us see, at the end of year 1, 40 points are redeemed. So we expected only 80 points to be redeemed, but out of them 40 points have already been redeemed at the end of first year. So revenue to be recognized in year 1 would be, we will take first of all points redeemed proportion to the expected number of points to be redeemed. 40 by 80 is 50%. 50% of 100 rupees is going to be recognized as revenue. So 50 rupees would be recognized as revenue in year 1. Balance to be carried forward. So deferred revenue to be carried forward would be, the total deferred revenue was 100. Out of that 50 has been recognized in year 1. Remaining 50 would be carried forward as deferred revenue. Now let us see what happens in the second year. At the end of year 2, number of reward points expected to be redeemed has increased to 90. So now the management estimates that more number of customers may come back to redeem those points. So even though we have granted 100 points, earlier we expected that only 80 points will be redeemed. Now our estimate has changed. We expect that customers who have 90 points are going to definitely redeem these we can say points, and 41 points redeemed during the year. So now how are we going to deal with it? See, the total number of points expected to be redeemed is 90. Out of them cumulatively 81 points have been redeemed. 40 in the first year, 41 in the second year. So 81 by 90, it comes to 90%. So 90% of 100 can be booked as revenue. So the cumulative amount of revenue which can be recognized up to year 2 is 90. Out of that 50 has already been recognized in the first year. Hence 40 will be recognized in the second year. So what is the balance amount to be carried forward? Out of 100, 50 was recognized in the first year, 40 has been recognized in the second year. The balance 10 would be carried forward as deferred revenue for third year. Now at the end of year 3, 9 points were redeemed. So at the end of year 3, remaining 9 points were redeemed. So total revenue to be recognized now, totally cumulatively 90 points have been redeemed. 40 in the first year, 41 in the second year, and 9 in the third year. So 90 divided by expected number of points, 90. That means 100% of the expected points have been redeemed. So the total cumulatively how much we can recognize as revenue is 100. So out of that, how much can be recognized for the third year? Out of 100, subtract revenue recognized for first year 50, revenue recognized for second year 40. So the balance 10 can be recognized as revenue for the third year. And the balance carried forward is nil because there is no more revenue to be recognized. Out of 100, 50 was recognized in the first year, 40 was recognized in the second year, and 10 was recognized in the third year. So this is how we are going to recognize revenue when the points are going to be redeemed. Okay. Now the second issue is if third party will supply the rewards. So what is this? I'll give an example. there's a credit card company, it tells its customer, if you use my credit cards, I'm going to give you some points. You can use these points to buy air tickets, or you can use these points to fly in an aircraft which is operated by an airline. That means I am granting the points, but points are being used to get rewards from a third party. So how do you account for it in the books of the, we can say, the guy who is maintaining the customer loyalty program, who is granting the points. So here, if a third party supplies the rewards, the entity shall assess whether it is collecting the consideration allocated to the points as a principal or as an agent. See, when the credit card company is granting points to its customer, it has to allocate a portion of the sale transaction to these points, and it knows that it has collected some consideration for the points granted. See, when some company is granting you some points, it is not giving it to you for free. They are collecting something from you for the purpose of granting those points. So when you buy goods from a company, the company is charging you for two things. One, for the goods and services which you have purchased from them, and second, for the points which they are granting to you. So now the question arises, I am selling goods to a customer, I am granting points to him, I know that I have collected something for those points, but I have to pass on some money to a third party because the rewards are going to be provided by a third party. So now the question arises, when I am collecting some money for the points granted, whether I am collecting it as a principal or as an agent of the third party which is going to provide the reward. I'll again explain it. I sell goods to customer, I get some consideration, in exchange I am providing the customer with goods and some points. I am collecting some revenue, okay, and I know that I have granted him some points. The customer can use these points to get reward from a third party. So the question arises, how much is the revenue I can show in my books of accounts? So standard says classify it. Are you collecting the money as a principal or as an agent? If the answer is agent, then in such case, what you have collected from the customer for the points granted and what you have to pay to the third party for providing the rewards to your customer, only the difference can be booked as revenue for you. Okay, so if you are collecting the money only as an agent, that means you collect something for those points and you hand over money to the third party to provide rewards in exchange for those points. In such cases, what you have collected for those points, subtract what you have to pay to the third party to provide those rewards. The net amount can only be recognized as revenue in your books of account. But suppose you are not collecting it as an agent, you are collecting it as a principal. That means if the third party fails to provide the reward, you have the principal obligation to provide the rewards. In such cases, whatever you have collected, you will show as revenue, and whatever you have to pay to the third party to provide the rewards, you will book it as an expense in your books of account. That means you will show the gross amount as revenue, and the amount payable to the third party to provide the reward will be shown as an expense. So if you are collecting the money as a principal, you can show the gross amount collected as revenue, provide for what has to be paid to the third party for providing the rewards. If you are collecting it only as an agent, that means you are going to collect and just pass on, and you do not retain the liability to provide the rewards. You tell the customer, boss, the rewards will be provided only by the airline and you cannot hold me responsible. In such cases, whatever I have collected, subtract whatever I have to pay to the third party, net amount I will book as revenue. I am not going to show the gross amount as revenue and the gross amount as expense. I am going to show only the net amount as income in my books of account. So this is how I do the accounting when a third party is going to supply the rewards. Now we have an example here. An electronic retailer operates a reward system under which a customer making a purchase worth ₹100 would get one reward point, which is an air mile offered by an airline. So electronics retailer, what he is saying is, if a customer comes to him and buys goods worth ₹100, he will grant him one reward point, and that one reward point is equal to one air mile, and the fair value of that one air mile is ₹1. The retailer would pass on 90 paise to the airline. So I am an electronic retailer, I don't maintain aircrafts to fly my customers, so I have to enter into a contract with an airline company. So if I am granting some air miles to my customer, the customers have to use these air miles to buy tickets from the airline, and the airline has to give them discounts, or they have to give them tickets for free. So airline has to be compensated by me. Okay, so I collect ₹1 for each air mile granted. I am going to pass on 90 paisa per air mile granted to my airline company. Okay, he made sales worth ₹1 crore during the year. So now customers have made purchases from the electronic retailer and he has made a sales of 1 crore. That means he has to grant 1 lakh points. 1 crore divided by 100. He has to grant 1 lakh points to its customer, or he can say out of 1 crore rupee sale consideration, 1 lakh points is equal to 1 lakh rupees. This amount I have collected for the points granted to the customer. And the customers can use these points or 1 lakh air miles to buy tickets from the airline. Now airline is not going to fly my customers for free. So I have to compensate him. Out of 1 lakh, 90,000 has to be passed on to the airline to provide the rewards in exchange for the point which I have granted to the customer. Okay. So now the question arises, if I am collecting the money as an agent, 1 lakh is what I have collected for the points granted, 90,000 is what I have to pass on to the airline. Only the 10,000 can be booked as revenue in my books of account as soon as the sale happens. Because see, here you have to see a particular point. The point is, if I do not retain the liability to provide the reward in exchange for these points, in such case immediately as soon as I make the sale, I know that if I am collecting 1 rupee for the point granted, 90 paisa I have to pass on to the airman, remain 10 paisa I can recognize as revenue immediately because I don't have any obligation in the future. But suppose I am collecting the money as a principal, that means I retain the principal liability to provide the reward in exchange for these points. In such cases, entire 1 lakh will be shown as revenue in my books, and also I would have to provide for 90,000 that is payable to the airline company for providing these services to the customer. So if I am collecting the money as an agent, 1 lakh minus 90,000. Net revenue only 10,000 will be booked in my accounts immediately. Second, if I am collecting the money only as a principal, not as an agent, in such cases 1 lakh will be shown as gross revenue and 90,000 will be booked as a provision for amount payable to the airline for providing services to my customers. So this is how I do the accounting in the case when the rewards are operated by a third party. Onerous contracts. There can be situations where the cost of providing rewards in exchange for those points may exceed the value of those points. That means the value of the points is only 10,000, but I have to incur 12,000 to provide rewards in exchange for these points. In such cases, such contracts will be called as onerous contract. So the additional 2,000 rupees has to be provided for immediately. So I have 10,000 worth of deferred revenue as a liability in my books, but I know that I have to spend 12,000 rupees to provide the benefits. In such case, another 2,000 rupees has to be provided immediately based on Indas 37. That is what the standard says. Okay. Now, how to determine fair value of the points? See, we initially discussed the fact that when sale transaction takes place, and in that sale transaction the company is providing some points to its customers. In such cases, out of the total sale consideration, a particular portion of the revenue has to be transferred, has to be allocated to these points, and it has to be treated as deferred revenue. So how should you allocate? How much should be allocated out of the initial sale consideration to these points is the question. The standard says based on fair value of the points. Okay. So if the rewards have quoted market, the rewards which we are going to give in exchange for those points, if they are traded in a market, in such cases the market value will be considered as the fair value of these reward points. If the reward point do not have a market, then estimation techniques have to be used. This is as per the application guidance which is attached to the standard. If fair value is, see, the fair value has to be determined from what the customer can get this from these points, then not from the point of view of the company. What is the cost that is going to be to the company for providing these benefits? So we have to consider the fair value from the point of view of the customer and not from the point of view of the company. So we are not going to consider what is the cost for providing these rewards. We have to consider what is the fair value for the customer to get these rewards from the, what is the fair value which the customer is getting from these rewards. Okay. So we have to decide from the point of view of the customer, not from the point of view of the company. What is the value to the customer for each point, and not is what is the cost for the company to provide these rewards. And if the customers can choose from a range of rewards with differing values, probability analysis has to be used. It may be onerous for the entity to maintain such data. Let us say, in exchange for these points, the customer has various options. He can either go for product A, product B, product C, product D, or service E. And each product is of different value. The rewards are of different value. In such cases, we have to estimate how many times customers have gone for product A, how many times customers have gone for product B, how many times customers have gone for product C, how many times the customers have used services E, and what was the fair value. So based on probability analysis, we have to arrive at the fair value of the points which is going to be treated as deferred revenue in our books of account. So this requirement of, we can say, using probability may require the entity to maintain lot of data, and maintaining that much data may become onerous for the company to implement this particular standard. So this is what we have to discuss in this particular appendix. Thanks a lot.